The single most dangerous number in the American economy right now is not the inflation rate. It is not the unemployment rate. And it is certainly not the price of Bitcoin today. It is $929 billion, a figure representing a massive ticking time bomb. This is the exact amount of commercial real estate debt maturing and crashing into a wall. We are witnessing the beginning of the largest asset deflation event in modern world economic history. It is a slow-motion demolition of the office towers, hotels, and shopping malls defining our skylines. For the last decade, the commercial real estate market was built on a foundation of cheap money. Developers borrowed billions at near zero interest rates to build glass towers in every major city. They assumed that interest rates would stay low forever and occupancy would remain at 100%. They were wrong on both counts, and now the bill is coming due with a vengeance. But unlike the 2008 financial crisis, which exploded overnight with the public collapse of Lehman Brothers, this crisis is happening in the shadows, hidden behind closed doors and complex accounting tricks. It is a silent crash quietly rotting the balance sheets of hundreds of regional banks across America. And if you think this does not affect you because you do not own an office building, you need to understand that your local bank likely does own one, indirectly using your deposits. Before we dive into the terrifying math of this collapse and how to protect yourself immediately, please make sure you're subscribed to the channel so you do not miss the updates. And comment down below where you're watching from. I want to see how global we are. To understand why this $900 billion wall is deadly, you must understand the loan. Commercial real estate loans are not like the 30-year fixed mortgage you have on your house. They are typically 5 or 10-year loans with a massive balloon payment due at the end. The developer pays only the interest for a few years, keeping their monthly costs artificially low, but at the end of the term, they must pay back the millions in principal immediately. In a normal economy, nobody actually pays off this balloon payment with their own cash reserves. They simply go to the bank, get a new loan, and use it to pay off the old. This process is called refinancing, and it is the lifeblood of the entire real estate industry. But today, the refinancing machine is broken, and the gears have ground to an absolute halt. The loans coming due right now were originated in the golden years of 2014, 2015, and 2019. Back then, the interest rate on a commercial loan was sitting comfortably at 3 or 4%. Today, if you walk into a bank to refinance that building, the rate is 8%. This means the interest payment on the debt has effectively doubled overnight for the struggling landlord. But the situation is actually much worse than just rising interest rates. Demand is totally broken. While the cost of debt has doubled, the income generated by these buildings has collapsed completely. We are living through a fundamental shift in how human beings work, shop, and live today. The work-from-home revolution was not a temporary pandemic trend. It was a permanent change. Office vacancy rates in major cities like San Francisco and Chicago are sitting near record highs. In some downtown corridors, 1 out of every 3 office windows is dark tonight, losing money. When a building has 30% vacancy, it is not just losing a little profit margin. It is cash flow negative, meaning the rent collected does not cover the mortgage and electricity. This creates a death spiral for the value of the building itself, making it unsellable. Commercial buildings are valued based on their net operating income, or the cash they generate monthly. When the income drops and interest rates rise, the value of the building plummets mathematically. We are seeing trophy assets in New York City selling for 50% less than in 2019. Imagine if your house lost half of its value overnight, but your mortgage payment doubled simultaneously. That is the exact mathematical reality facing thousands of landlords and pension funds across America today. So why haven't we seen a wave of massive bankruptcies on the nightly news just yet? Why aren't banks seizing these towers and putting for sale signs in the lobby for everyone? Because of a strategy that Wall Street insiders call extend and pretend, a dangerous game of delay. The banks know that if they foreclose on these buildings, they have to record the loss. If they take a $50 million building back that is now worth only $20 million, they have to wipe $30 million of equity off their own balance sheet instantly. For many regional banks, taking these losses would wipe out their capital reserves completely and destroy them. It would make them technically insolvent and force regulators to shut them down on Friday night. So instead of facing reality, the banks are playing a dangerous game to keep doors open. They are allowing delinquent borrowers to extend the loan for another year, even if unpaid. They are pretending that the building is still worth the old price to avoid the write-down. They are praying that interest rates will crash back down to 0 before the extension expires. But this strategy does not fix the problem. It only makes the bubble bigger and louder. It turns a manageable liquidity crisis into a massive solvency crisis that grows larger every day. The maturity wall of 2024 was just the first wave of this tsunami hitting the shore. There's another $957 billion maturing in 2025, waiting right behind it. And the vast majority of these loans are held by the banks you use every day. Regional and community banks hold nearly 70% of all commercial real estate debt in America. These are not the too big to fail giants like JP Morgan or Bank of America. These are the mid-sized lenders that power small businesses and local economies in your town. They are loaded to the gills with loans on strip malls, medical offices, and suburban parks. And as these loans hit the wall, the banks are forced to hoard their cash tightly. This brings us to the credit crunch that is strangling the real economy and small businesses. Because the banks are terrified of their real estate exposure, they have effectively stopped lending money. Try getting a loan for a small business expansion or a new equipment purchase right now. You will find that the bank officers are polite, but the answer is almost always no. They cannot lend to you because they need every dollar to cover the coming real estate losses. This sucks the liquidity out of the economy and slows down growth on Main Street significantly. It creates a zombie banking system where banks exist, but do not actually function as lenders. They are merely warehouses for bad debt, waiting for a government bailout or a total collapse. The regulators in Washington are fully aware of this ticking time bomb, but are powerless. The Federal Reserve has been quietly signaling banks to build up their loss reserves for months, but asking a bank to build reserves while their assets are crashing is physically impossible today. It is like asking a starving man to save food for next winter when he has nothing. The only way out of this trap is for prices to reset to reality, forcing losses. But a reset of 50% in commercial real estate is a systemic shock to everyone. It would wipe out more wealth than the 2008 subprime mortgage crisis did, affecting pension funds. So the entire system is frozen, locked in a tense stare-down between lenders and borrowers. The borrowers are threatening to mail the keys back to the bank and walk away forever. This is exactly what huge asset managers like Brookfield and Blackstone have already started doing recently. They are calculating that the property is worth less than the debt, so they default strategically. They view it as a cold business decision, a strategic default to cut their losses now. But for the bank on the other side of that deal, it is a complete catastrophe. They are stuck with an empty office building that costs millions a year to maintain securely. They have to pay the property taxes, the security guards, and the electricity bills for empty shells. They are not property managers, they are financial institutions, and they are drowning in physical assets. This silent crash is gathering speed as we move deeper into the fiscal year earnings season. The data from the Mortgage Bankers Association shows delinquencies ticking up significantly every single quarter. The cracks in the dam are starting to spray water and the pressure is building rapidly. Investors who are paying attention are starting to short the stocks of exposed banks, betting heavily. They are looking at the loan-to-value ratios and realizing the equity is completely gone. The market is realizing that the extend and pretend game has a mathematical limit we are reaching. You can extend a loan for a year, maybe two, but you cannot extend it forever. Eventually, the wall hits back, and the fantasy of high valuations dissolves instantly into thin air. We are approaching that limit right now, and the fallout will be spectacular for the unprepared. The first dominoes have already fallen in the major metropolitan markets like San Francisco and Los Angeles. San Francisco has seen buildings sell for 70% off their previous sale price, shocking everyone. A tower that sold for $300 million is now trading for $60 million, destroying equity. That is not a market correction. That is a complete and total market collapse of value. And this contagion is spreading from the coast to the heartland of the country, affecting every state. The realization of these losses will trigger the next phase of the banking crisis we uncover next. The banking crisis everyone fears is not coming in the future. It is already here today. If you look closely at the regulatory filings, you can identify the next victims right now. Banks are required to report their CRE concentration ratios to the FDIC every single quarter without fail. This ratio measures how much commercial real estate debt they hold compared to their total capital reserves. When a bank has 300% more real estate loans than capital, red lights flash immediately. Regulators view this as the danger zone where a small drop in value wipes them out completely. Right now, there are hundreds of banks across America sitting well above this fatal red line of insolvency. Some have concentration ratios of 400, 500, or even 600% today, which is terrifying. These institutions are effectively walking zombies, kept alive only by accounting loopholes and regulatory patience. They are gambling that the Federal Reserve will cut rates aggressively to save them from total ruin. But the Fed is trapped by inflation and cannot lower rates fast enough to help them survive. Even if rates drop by 1%, these loans are still deeply underwater and completely toxic assets. The gap between the old rate of 3% and the new rate is simply too wide to bridge. This means the banks must eventually raise new capital or sell the bad loans immediately to survive. But raising capital is expensive when your stock price is crashing and investors are scared to death. And selling the loans means crystallizing the losses they are desperately trying to hide from you and the public. So they are stuck, paralyzed by the fear of triggering a massive run on their deposits overnight. This paralysis is what creates the silent credit crunch that we are living through right now in real time. But there is a secondary explosion waiting to happen in the shadow banking sector as well that nobody watches. Not all commercial real estate debt is held by traditional FDIC-insured banks that you know and trust. A massive chunk is held by debt funds, insurance companies, and unlisted REITs operating in the shadows. These shadow banks do not have access to the Fed's emergency lending window for liquidity when panic hits. When they run out of cash, they cannot just borrow more from the government like traditional banks can. They have to liquidate assets immediately, selling into a market with absolutely zero buyers today at any price. Blackstone's Brait fund was the canary in the coal mine for this terrifying trend last year. When investors tried to pull their money out, the fund had to limit withdrawals instantly to stop the bleeding. They simply could not sell the buildings fast enough to pay back the panicked investors who wanted out. This gating of funds creates panic and causes even more investors to queue up to exit simultaneously. It destroys the illusion of liquidity that real estate funds rely on to sell shares to the public. But the most terrifying part of this story involves commercial mortgage-backed securities, or CMBS bonds. These are the complex bonds that package thousands of loans into a single tradable security sold to pensions. Pension funds and retirement accounts buy these bonds for their safe yield and perceived stability over time, but the loans inside these bonds are starting to rot from the inside out rapidly as defaults rise. The delinquency rate on office CMBS loans has spiked to levels not seen since 2012 and is rising. When a loan in the bundle defaults, the bond stops paying interest to the investor immediately and permanently. Suddenly, the safe portion of your portfolio is taking a massive haircut without any warning whatsoever. The rating agencies are scrambling to downgrade these bonds, but they are already too late to warn investors. Just like in 2008, they gave AA ratings to garbage debt that is now defaulting left and right. The entire ecosystem of real estate finance is built on confidence and massive amounts of leverage. When confidence evaporates, the leverage turns into a wrecking ball that destroys equity holders in seconds. We are seeing this wrecking ball smash into the medical office sector right now too, which was unexpected. For years, investors thought medical offices were recession-proof and safe because doctors always pay their rent on time. But the operators of these facilities are being squeezed by rising labor costs and inflation in healthcare. They cannot pay the higher rents, and they are vacating the buildings in record numbers across the country. This adds another layer of toxicity to the bank balance sheets that nobody expected or modeled for. It proves that there is no safe haven within the commercial real estate market today for any investor. Even multifamily apartments, the darling investment of the last decade, are cracking under pressure of oversupply. In the Sunbelt cities like Austin and Phoenix, new supply is flooding the market and crushing rental prices. Developers built too many luxury units just as migration started to slow down significantly in those regions. Rents are falling, but the debt payments on these massive complexes are rising fast due to floating rates. This creates a negative leverage situation that burns through equity capital incredibly rapidly for the owners. The syndicators who raised money from doctors and dentists are sending bad news letters to their investors daily. They are making capital calls, asking investors to send more cash to save the deal from foreclosure. But most investors do not have the cash, or they refuse to throw good money after bad investments. So the properties go back to the lender, adding to the pile of distressed assets on bank books. The sheer volume of this distress is overwhelming the court system in some states completely and causing delays. Foreclosure courts are backed up for months, delaying the resolution of these bad debts and trapping collateral. This legal purgatory allows the zombie buildings to sit empty and deteriorate physically every single day. An empty building is a dying building. Pipes burst, mold grows, and vandals strike often without security. By the time the bank gets the title, the asset is worth even less than before the foreclosure. This physical decay compounds the financial decay, accelerating the losses for the banking system and the economy. And we haven't even talked about the refinancing gap yet, the math problem that kills every deal. This is the difference between the loan amount coming due and the new loan the bank offers. If a building has a $100 million loan coming due this month for repayment, but the bank says the building is now only worth $80 million today in the current market, the bank will only lend roughly $50 million on that new lower value to protect themselves. This leaves a gap of $50 million that the borrower must pay in cash immediately to refinance. If the borrower does not have $50 million in cash, they lose the building to the bank. This gap is the mathematical certainty that guarantees thousands of defaults in the coming months across America. There is simply not enough equity capital in the world to fill these massive holes in the balance sheets. The rescue capital that is forming is demanding shark-like terms to enter the market and provide liquidity. They want preferred equity positions that pay 15% interest to take the risk of these assets. Taking that money usually wipes out the original equity owners anyway, leaving them with absolutely nothing. So the owners are faced with a terrible choice. Lose it now or lose it later with more debt. Most are choosing to delay, hoping for a miracle that is simply not coming from the Federal Reserve. The maturity wall is unforgiving. It acts as a forcing function for the entire market to reset prices. It forces the price discovery that everyone has been trying to avoid for years to protect their egos. And when price discovery happens, it reveals the true extent of the wealth destruction that has occurred. This destruction is not just a problem for rich developers and Wall Street bankers in high towers. It flows downstream to the construction workers who build the tenant improvements in offices for new companies. It flows to the furniture companies that outfit the new offices with desks and chairs for employees. It flows to the janitorial companies that clean the floors at night for the tenants who are leaving. The commercial real estate ecosystem supports millions of blue-collar jobs across the United States economy right now. When the ecosystem freezes, those jobs disappear without a headline on the nightly news or a government bailout. We are already seeing a slowdown in commercial construction starts nationwide due to financing issues and lack of demand. Architectural billings, a leading indicator for future construction, have been negative for over a year now. This signals that no new projects are entering the pipeline for the future economy in any major city. The industry is contracting, shrinking down to fit a smaller, remote work world that emerged from the pandemic. But the debt remains sized for the old, expansionary world that no longer exists. In reality, this mismatch between the debt size and the industry size is the core crisis we are facing. It is a debt overhang that will drag on the U.S. economy for a decade, slowing growth significantly. Japan went through this in the 1990s after their real estate bubble burst spectacularly and destroyed their growth. They had zombie banks and a lost decade of stagnation and low economic growth that haunts them. The United States is walking down the exact same path right now with our banks and real estate. How do you navigate a financial world where the bedrock of the banking system is crumbling beneath our feet? You start by fundamentally understanding that your bank is not a vault. It is a highly leveraged hedge fund. It takes your hard-earned deposits and bets them on long-term illiquid loans like commercial real estate assets. When those bets go bad, as they are doing right now across the country, your safe money is at risk. The FDIC protects deposits up to a specific limit, but it cannot protect the broader economy from a collapse. It cannot protect your small business from a sudden credit freeze or your home from falling property values. The silent crash in commercial real estate acts as a massive deflationary drag on every other asset class. It is a deflationary black hole that sucks liquidity and capital away from productive uses in the real economy. Instead of funding new startups and innovations, money goes to plug massive holes in regional bank balance sheets. This leads to a stagnant, low-growth environment, a zombie economy that shuffles along without creating real prosperity. To protect yourself in this environment, you must first ruthlessly scrutinize your own personal banking relationships today. Do not keep more than the federally insured limit in any single regional bank, no matter how safe they claim to be. Spread your liquidity across multiple systemically important institutions that the government has implicitly guaranteed to save. It is unfair that the big banks are safer than the small ones, but that is the reality we live in. Second, if you run a business of any size, you must secure your credit lines immediately before you need them. Do not wait until you have a cash flow crunch to ask the bank for money, because they will say no. In a credit crunch, lines of credit are cut without warning or explanation to preserve the bank's capital ratios. Draw down what you need now and keep it in a separate, safe account earning interest as an insurance policy. Cash on hand is the ultimate hedge against a banking liquidity crisis because it gives you options when others have none. Third, you need to look at the real estate market dynamics in your specific zip code and city. Real estate is hyperlocal, and the contagion of the commercial crash spreads differently in every single city. If you live in a city with high office vacancy rates, you should expect significantly higher local taxes soon. City councils will be forced to raise property taxes on residential homes to fill the massive budget gaps. They will increase fees on water, trash, and building permits to survive the loss of commercial tax revenue. Be prepared for this fiscal drag on your personal monthly budget, as it will eat into your disposable income. Fourth, avoid investing in passive real estate funds that lock up your money for long periods of time. Non-traded REITs and private syndications are dangerous liquidity traps right now because you cannot exit when you want. You cannot sell your shares when you need the cash. You can only sell when the fund manager allows it. Stick to liquid assets that you can convert to cash in seconds, like treasury bills or highly liquid stocks. Illiquidity is the enemy that kills investors during a maturity wall event, and you must avoid it at all costs. But there's also an offensive strategy for the bold investor who has patience and capital to deploy. The great transfer of wealth we discussed creates once-in-a-lifetime opportunities for those who are prepared to act. Distressed commercial assets will eventually sell for pennies on the dollar, resetting the market to a new baseline. Cash-rich investors will be able to buy prime real estate assets at prices we haven't seen since the 1990s. But you must have extreme patience. Do not try to catch a falling knife before it hits the floor. Wait for the capitulation phase where the banks are forced to dump assets at any price to clear their books. That phase has not fully started yet. We are still in the extend and pretend phase of the cycle. Keep your powder dry and watch the special servicing data closely for the signal that the dam is broken. When the foreclosure auctions begin in earnest in your city, that is the signal to start looking for deals. The maturity wall creates a binary outcome for the economy, either massive inflation or massive deflation. Either the Fed prints trillions to bail out the landlords and banks, inflating the dollar and destroying purchasing power, or they let the market crash naturally, deflating asset prices and causing a painful but necessary recession. Currently, they are choosing a middle path of slow suffocation, hoping that time will heal the wounds naturally. But time is running out because the debt wall gets higher in 2026 and 2027, not lower. And the cultural shift away from 5-day-a-week office work is not reversing anytime soon, if ever. Hybrid work is here to stay, meaning the structural demand for office space is permanently lower than before. We have a massive structural oversupply of office buildings that must be repurposed or demolished entirely. Converting them to apartments is expensive and often physically impossible due to floor plates and plumbing issues. So we will see the creative destruction of the American city center as old towers are torn down. Land values in these areas will reset to zero or near zero before redevelopment can actually make financial sense. This is a painful but necessary evolution of the physical economy to match the new digital reality. The danger is that the banking system dies from the losses before the evolution is complete. That is why you must watch the Federal Reserve's Bank Term Funding Program expiration dates very carefully. If the Fed pulls the plug on emergency liquidity, the weakest banks will fall into receivership overnight. We saw this happen with Silicon Valley Bank and First Republic, but those were just the early tremors. The maturity wall earthquake is slower, deeper, and more widespread, affecting the foundation of the entire system. It affects thousands of banks, not just a few tech-focused ones, and it touches every main street in America. It affects every town that has a half-empty medical building or a strip mall losing its anchor tenant. So, what is the ultimate endgame for the $929 billion of maturing debt? Most of it will be restructured, meaning the investors and equity holders will take a 100% loss. Equity will be wiped out, and the debt holders, the banks and bondholders, will become the new owners. The pension funds that hold this debt will see their returns diminish, impacting the retirement security of millions. This puts immense pressure on the retirement system of public employees and the budgets of states and cities. It is a hidden tax on the savers of the country who trusted these funds to manage their risk. You pay for the reckless lending of the past through lower future returns and higher taxes in the present. This is why self-custody of your wealth and active management is so important in this new era. You cannot rely on the opaque institutions to manage risk for you because their incentives are misaligned. They have proven time and again that they will chase yield off a cliff to earn their fees. You must be the risk manager of your own life and fortune, understanding every asset you own. Understand the specific exposure of your investments to the commercial real estate sector and the regional banking sector. Read the fine print of your mutual funds and ETFs to see what they actually hold inside. If they hold regional bank debt or CMBS bonds, know the risks you are taking with that capital. Rotate into sectors that are immune to the office vacancy crisis and the credit crunch we are facing. Energy, defense, and commodities do not care if office towers in San Francisco are empty or full. They are tangible assets that the world needs regardless of where people work or how they bank. The silent crash is a stark reminder that debt is a double-edged sword in the economy. It boosts growth on the way up, creating a feeling of wealth, but it crushes value on the way down. We are on the way down now, sliding down the back of the maturity wall with no brakes. The ride will be bumpy and the landing will be hard for those who are not prepared. But if you are prepared with cash, knowledge, and patience, you can walk away from the crash intact. You can position yourself to pick up the pieces and build real generational wealth from the ashes. The maturity wall is a clearing event, a forest fire that burns the dead wood to allow new growth. It is scary to watch, but it clears the ground for a healthier, more sustainable economy in the future. The key is to make sure you are not the dead wood that gets burned in the process. Stay liquid, stay skeptical of official narratives, and stay alert to the market signals we discussed. The banks will not tell you when they are in trouble until the doors are locked. The government will not tell you the severity of the crisis until it is too late to act. You have to look at the numbers yourself, and the numbers are screaming a warning right now. $929 billion is screaming that a correction is imminent and unavoidable. The vacancy rates are screaming that the value of these assets has permanently impaired. The silent crash is getting louder every day, moving from the financial pages to the front pages. Listen to it and act accordingly to protect your family and your financial future today. We will continue to track every bank failure, every foreclosure, and every policy change for you. We will bring you the hard data that the mainstream media ignores or glosses over to keep you calm. Because in a crisis like this, information is the most valuable asset you can possibly own. This is not the end of the real estate market, but it is a massive reboot of the system. And in a reboot, the operating system changes, and the winners and losers are reshuffled. Make sure your personal operating system is updated for the new reality of high rates and low liquidity, the reality of the great unwind that is reshaping our world and our wallets in real time. Thank you for watching this deep dive into the maturity wall and the future of real estate. If you found value in this report and want to stay ahead of the curve, please subscribe to the channel. Turn on the notifications so you are alerted the moment the next bank breaks or policy changes. Share this video with anyone who owns a business or real estate. They need to know what is coming. We are in this together, navigating the storm one chart and one data point at a time. I will see you in the next video with more hard data and analysis to help you survive. Until then, protect your wealth, watch the wall, and stay safe out there.